For nearly 80 years, one currency has quietly shaped the global economy. It finances international trade, backs the world's largest financial markets, and sits inside the vaults of almost every central bank on Earth. That currency is the US dollar. But something unusual has been happening behind closed doors. Without dramatic announcements or headline-grabbing speeches, central banks around the world have been changing how they manage their national reserves. They've been buying gold at the fastest pace in decades. They've been signing trade agreements that bypass the dollar. And they're investing in alternative payment systems designed to reduce dependence on the world's dominant reserve currency. Does this mean the US dollar is losing its position? Is the world witnessing the beginning of a new financial order? Or are governments simply preparing for a future that looks very different from the past? The truth is far more complex and far more interesting than the sensational headlines suggest. Today, we'll uncover why central banks are quietly changing their strategy, what these decisions reveal about the future of global finance, and whether the world is slowly moving toward a post-dollar era. But to understand why countries are diversifying today, we first need to understand how the US dollar became so powerful in the first place. The US dollar didn't become the world's dominant currency by accident. Its rise began during one of history's most turbulent periods, World War II. In 1944, representatives from 44 Allied nations met in Bretton Woods, New Hampshire, to design a new international monetary system. Their goal was simple: rebuild the global economy after the war and prevent another financial collapse like the Great Depression. The agreement they reached fundamentally reshaped global finance. Instead of every country relying on gold directly, most major currencies would be tied to the US dollar. In turn, the United States promised that foreign governments could exchange dollars for gold at a fixed price of $35 per ounce. Because the United States held the world's largest gold reserves and emerged from the war with the strongest economy, the arrangement inspired confidence. The dollar quickly became the foundation of international trade. Although President Richard Nixon ended direct dollar-to-gold convertibility in 1971, something remarkable happened. The dollar retained its dominant position. By then, governments trusted U.S. financial institutions. American Treasury securities had become one of the world's safest assets, and international trade was already deeply connected to the dollar. Another important development strengthened this dominance even further. During the 1970s, global oil trade became largely priced in U.S. dollars. Countries buying oil needed dollars regardless of where they were located, creating constant worldwide demand for the currency. Over time, the dollar evolved into much more than America's national currency. It became the backbone of international finance. Today, according to the International Monetary Fund's COFR data, roughly 58% of officially reported global foreign exchange reserves are still held in US dollars. Most international commodities continue to be priced in dollars. The U.S. Treasury market remains the largest and most liquid government bond market in the world, and the dollar continues to dominate cross-border financial transactions. With advantages like these, replacing the dollar isn't easy. So why are central banks beginning to rethink their strategy? The answer isn't that they're abandoning the dollar. They're reducing their dependence on any single asset. Unlike investors, central banks don't chase short-term profits. Their primary responsibility is protecting financial stability. That means preparing for risks long before those risks become obvious. Over the last several years, central banks have quietly adjusted how they manage their reserves. One of the clearest trends has been diversification. Instead of concentrating reserves almost entirely in dollars, many countries are gradually increasing holdings of other assets, including gold and, to a lesser extent, other currencies. This change has accelerated in recent years. According to the World Gold Council, central banks have collectively purchased more than 1,000 tons of gold annually in consecutive years, the highest sustained level of buying in modern records. Countries including China, India, Poland, Turkey, Singapore, and several emerging economies have expanded their gold reserves. At the same time, some governments have increased the use of local currencies in bilateral trade agreements. China and Brazil agreed to facilitate parts of their trade using their own currencies. India has promoted mechanisms that allow trade settlements in Indian rupees with selected partners. Several ASEAN countries have also explored greater use of local currencies for regional transactions. These developments often generate dramatic headlines claiming that countries are ditching the dollar. That description is misleading. The reality is much more measured. The dollar remains the world's dominant reserve currency. Most international trade still relies on it. Most global debt is still denominated in dollars. And no single alternative currently offers the same combination of liquidity, trust, and market depth. What central banks are doing is something much more strategic. They're building resilience. Rather than depending almost entirely on one reserve asset, they're creating portfolios designed to perform under a wider range of economic and geopolitical conditions. And one asset has become central to that strategy: gold. For thousands of years, gold has served one essential purpose: trust. Unlike paper currencies, gold isn't issued by any government. It can't be printed. It doesn't depend on the financial health of a single country. And it carries no counterparty risk. If a central bank owns physical gold stored in its own vaults, that asset cannot be created, diluted, or canceled by another nation. That characteristic has become increasingly valuable in today's geopolitical environment. Russia's foreign exchange reserves frozen after the invasion of Ukraine highlighted an important reality for many governments. Reserve assets held abroad may become inaccessible under certain geopolitical circumstances. Whether countries agree or disagree with those sanctions is beside the point. The event demonstrated that reserve management now involves geopolitical considerations as well as economic ones. Gold offers something different. It sits outside the liabilities of another country's financial system. For central banks, that makes it an effective form of financial insurance. Gold also tends to perform well during periods of inflation, currency uncertainty, and financial stress. While its price fluctuates in the short term, its long-term role as a store of value remains one of the reasons central banks continue accumulating it. But gold isn't replacing the dollar. It serves a different purpose. The dollar provides liquidity for trade and investment. Gold provides stability during uncertainty. Modern reserve management increasingly relies on both. Yet diversification extends beyond gold alone. Countries are also investing in new financial infrastructure that could gradually reshape how international payments are made. And that's where the story becomes even more interesting. While gold has become one pillar of reserve diversification, it isn't the only change taking place. Around the world, governments are quietly building new ways to conduct international trade and payments. These changes aren't designed to overthrow the US dollar overnight. Instead, they aim to reduce the risks of relying too heavily on a single financial system. One of the most closely watched developments has been the expansion of the BRICS group. Originally made up of Brazil, Russia, India, China, and South Africa, the bloc has expanded to include several new members from the Middle East and beyond. Together, these countries represent a significant share of the world's population, energy production, and economic output. For years, BRICS leaders have discussed increasing trade in their own national currencies. Rather than converting everything into US dollars first, countries can settle certain transactions directly in currencies like the Chinese yuan, Indian rupee, or Brazilian real. Similar efforts are appearing elsewhere. China has steadily promoted international use of the yuan through currency swap agreements with dozens of central banks and by expanding its cross-border interbank payment system, commonly known as CIPS. India has introduced mechanisms allowing selected trading partners to settle transactions in rupees. Several ASEAN nations have also announced initiatives encouraging greater use of local currencies for regional trade and investment. At the same time, central banks across the world are experimenting with central bank digital currencies, or CBDCs. Unlike cryptocurrencies such as Bitcoin, CBDCs are digital versions of official national currencies issued directly by central banks. While many projects remain in the testing phase, policymakers see them as a way to improve payment efficiency and facilitate faster cross-border transactions. These initiatives often fuel speculation that the dollar's dominance is coming to an end, but the evidence suggests something more nuanced. Alternative payment systems remain relatively small compared to the global infrastructure built around the US dollar. Most international trade financing, sovereign borrowing, commodity pricing, and foreign exchange markets still depend heavily on dollar liquidity. Creating an alternative isn't simply about choosing another currency. It requires decades of trust, deep financial markets, legal certainty, transparent institutions, and a global network of investors willing to hold that currency. Those foundations cannot be built overnight. So rather than replacing the dollar, these initiatives are gradually giving countries more options. The global financial system isn't necessarily becoming less connected. It's becoming more diversified. And that brings us to the biggest question of all. If countries are preparing alternatives, what does that mean for the future of the US dollar itself? Predictions about the collapse of the US dollar are nothing new. For decades, analysts have forecast the end of dollar dominance. Yet the dollar has repeatedly remained at the center of the global financial system. Why? Because reserve currencies benefit from powerful network effects. Businesses invoice in dollars because their suppliers and customers already use dollars. Banks lend in dollars because borrowers demand dollar financing. Investors purchase U.S. Treasury securities because they are among the most liquid and widely traded government bonds in the world. And central banks continue holding dollars because they know other central banks do the same. That cycle reinforces itself. Breaking it is extremely difficult. The United States also possesses advantages that no other country currently matches. The financial markets are unmatched in size and liquidity. The Treasury market provides a safe and highly liquid destination for global reserves. American institutions remain highly influential. And despite political disagreements, investors continue viewing U.S. government debt as one of the world's benchmark safe assets during periods of market stress. But none of this means the dollar's position is guaranteed forever. The global economy is changing. Government debt levels are rising. Interest payments are becoming more expensive. Economic power is spreading across multiple regions. Emerging economies now account for a larger share of global growth than they did several decades ago. Technology is also transforming international finance. Digital payment systems, new settlement networks, and regional financial cooperation are giving countries more flexibility than ever before. Rather than relying on one dominant reserve asset, central banks increasingly appear to be adopting a strategy of diversification. More gold, more regional trade, more local currency settlements, more payment options. Not because the dollar is suddenly failing, but because prudent risk management encourages preparation for multiple possible futures. History offers an important lesson. Reserve currencies rarely disappear overnight. The British pound did not lose its global influence in a single year. Its dominance gradually declined over decades as economic power shifted. If the international monetary system changes again, history suggests the transition would likely be slow, uneven, and measured, not sudden or chaotic. That is exactly why central banks are acting years in advance. They aren't trying to predict tomorrow's headlines. They're preparing for the next several decades. So, are central banks secretly moving away from the US dollar? The answer is both yes and no. Yes, they're reducing dependence on a single reserve asset. They're buying record amounts of gold. They're expanding local currency trade. They're exploring new payment systems and strengthening regional financial cooperation. But no, they are not abandoning the dollar. At least not today. The US dollar remains the world's dominant reserve currency because it continues to offer something no competitor has fully matched: deep financial markets, global liquidity, and decades of accumulated trust. What we're witnessing isn't the collapse of one system. It's the gradual evolution of another. The future may not belong to a world dominated by only one reserve currency. Instead, it may be defined by a more diversified financial landscape, where the dollar remains central but shares greater influence with gold, regional currencies, and new payment technologies. For investors, businesses, and policymakers, Understanding this shift is more important than predicting dramatic headlines. Because history's biggest financial changes rarely happen all at once. They unfold quietly, year after year, while most people are paying attention to something else. And by the time the new system becomes obvious, the world's central banks have already been preparing for it for years. If you enjoyed this documentary and want more in-depth analysis of the forces shaping the global economy, consider subscribing to Finance Debates. Every week, we break down the world's biggest business, finance, and geopolitical stories using facts, historical context, and data, not hype. Thanks for watching, and we'll see you in the next documentary.